everyone. In this video, we will learn about Forex Market, currencies available for trading in India, factors to look out when trading USDINR, factors to look out when trading currency pairs in India, and how to trade currencies. What is Forex Market? The Forex market is the largest and the most liquid financial market in the world, with daily volumes exceeding $6 trillion. Forex market is a market where currencies are exchanged for one another. Various currencies traded in the Forex market include US dollars, euro, pound sterling, Chinese yuan, Indian rupee, Australian dollar, Canadian dollar, Russian ruble, Brazilian real, etc. One thing to remember that currencies are always traded in pairs. For instance, one could be buying euros by selling dollars. A currency is never expressed in isolation, but rather in pairs. Forex market is open virtually 24 hours a day for 5 days a week. Trading hours on each day can be divided into 3 sessions. First, the Tokyo session, which is usually active between 5 a.m. IST to 1 p.m. IST. Second, the London session, which is usually active between 12 p.m. IST to 9 p.m. IST. Third, the New York session, which is usually active between 6 p.m. IST to 2 a.m. IST. Now let's see currencies available for trading in India. The most traded currency in India against the rupee is the dollar. Besides the dollar, the other currencies that are available for trading in India include the euro, the pound sterling, and the Japanese yen. These instruments are available for trading in the derivative segment too. The 3 major currency pairs, Euro USD, GBP USD, USD GPY, are also traded on the NSE, but volumes tend to be low. The major exchanges that permit the trading of currency derivative in India are the NSE BSE and the MCX SX. Factors to look out when trading USDINR. First, CPI and WPI data. A stronger than expected inflation reading is usually positive for the currency, as it increases expectations of tighter monetary policy. Alternatively, a weaker than expected inflation reading is usually negative for the currency, as it increases expectation of a looser monetary policy. Second, trade balance data. If a nation is experiencing trade deficit, then a widening of the deficit is likely to pressurize its currency, while narrowing of the deficit is likely to underpin the currency. On the other hand, if a nation is experiencing trade surplus, then widening of the surplus is likely to underpin its currency, while a narrowing of the surplus is likely to weaken the currency. Third, GDP data. A stronger than expected GDP data means a stronger level of economic activity in the nation, which is positive for the currency. On the other hand, a weaker than expected data means the level of the economic activity in the economy is not strong as anticipated, which is negative for the currency. Fourth, FI inflows and outflows. Foreign money flows into and out of the economy based on the outlook for that economy. The stronger the outlook, the stronger would be the inflow into the nation. On the other hand, the weaker the outlook for an economy, the weaker would be the inflow into that economy. Furthermore, the existing foreign investors might also withdraw their invested money from that nation, further leading to the currency depreciation. Factors to look out when trading currency pairs in India. First, Central bank monetary policy. Central bank, by using its monetary policy tools, can adjust the level of interest rate and money supply in the economy based on the incoming set of economic data and economic development. Second, employment data. Employment data is quite crucial for the forex market. A stronger than expected labor data is positive for the currency, while a weaker reading is negative for the currency. Inflation data. Inflation is the general increase in the price level of goods and services in the economy. A moderate increase in the price level of goods and services is generally accepted and in fact benefits the growing economy. However, too much inflation erodes the value of money, which creates problem on the individual level as well as on the economy level. Fourth, retail sales data. A stronger than expected retail sales data indicates higher spending by consumer, which is usually positive for the currency. Alternatively, a weaker than expected reading is usually negative for the currency, as it indicates lower consumer spending. Fifth, trade balance data. If a nation is experiencing trade deficit, then widening of the deficit is likely to pressurize its currency, while narrowing of the deficit is likely to underpin the currency. On the other hand, if a nation is experiencing trade surplus, then widening of the surplus is likely to underpin its currency, while narrowing of the surplus is likely to weaken the currency. Sixth, short-term risk appetite. Short-term risk appetite is important because it affects currency movements. Typically, during times of risk aversion, the dollar, the yen, and the Swiss franc tend to strengthen, while commodity and emerging market currencies tend to weaken. The opposite is true during times of positive risk appetite. 7th, bond yields. Rising bond yields usually cause the currency of that country to appreciate. Similarly, as bond yields move south, so does the currency of that country and usually cause the currency of that country to depreciate. 8th, trend of the DXY. DXY strength means the dollar is strengthening against its peers and vice versa. So, during times when DXY is strengthening, the rupee tends to weaken and vice versa. Strategies for forex trading in India. In this part, I am going to discuss different strategies for taking currency trade. First, price action trading. The price action strategy is the most commonly used forex trading strategy. Price action trading is a strategy that helps to predict market movements by spotting patterns or signals in the price movements of an underlying market. Some of the price action strategies are price action trend trading, trend following, retracement entry, head and shoulder top, inverse head and shoulder, and many more. Price action trend trading. Price action trend trading is the study of trends. This is the chart of US dollar. You can see in the month of August, prices slightly correct and then took support near to 92 levels and form a positive pattern. Thereafter, US dollar continue its northbound journey. And in the month of Feb, a slight selling pressure was witnessed and it formed a bearish pattern. Thereafter, it corrected and took support near to 95 levels. After taking support, it continued its upside journey. So, in this, you can see that the long-term trend continues its upside journey. Trend following retracement entry. Fibonacci retracement is one of the most used price tools by chartists. It is used to find areas of support after a rally in price or to find areas of resistance after a decline in price. The most commonly used Fibonacci retracement ratios are 23.6%, 38.2%, 50%, 61.80%, and 76.40%. So this is the chart of US dollar, and you can see that in the month of February, the prices has formed a bearish pattern, and thereafter it corrected, and it took support exactly to 61.80% retracement level of this whole rally, and form a positive pattern over there, and thereafter it continues its upside journey. Head and shoulder reversal trade. The head and shoulder reversal trade is one of the most popular price action trading strategy, as it is relatively easy to choose an entry point, stop loss and the target. So this is US dollar chart. In the year 2006, you can see that the prices has formed head and shoulder pattern and gave a neckline breakdown. So when prices give a neckline breakdown, at that level you can go short in the US dollar. And at that time the price was at around 90 levels. After that the prices corrected to 70 levels. If you are doing a short position below the neckline, the target can be around 70 to 65 and the stop loss will be around 90 to 50, which is the highest price also and the head of the head and shoulder pattern. Now let's see the second strategy. So the second strategy is trend trading strategy. Trend trading is a strategy that involves using technical indicators to identify the direction of market momentum. Trend trading is usually considered a mid to long-term trading strategy. It is usually adopted by traders who prefer a positional trading or swing trading style. Trend trading strategies are designed to help you identify trends as early as possible and exit the market before they reverse. There are three types of trends: uptrend, downtrends, and sideways trends. There are varieties of ways to identify these primary trends, including looking at price action, but the most common trend trading strategies use technical indicators. Popular trend trading indicators include moving average, relative strength index, and average directional index. Moving average. A moving average is one of the oldest and most frequently used tools by chartists. A moving average is the average price of the security over the past n periods. The average price should be the average of closing price, opening price, high price, low price, or combination of thereof. This is USD dollar chart, and you can see that in the month of April till July the prices were consolidated and even the average was trading very range bound. However, by the end of the July we saw a crossover of 50-day moving average from the upside, and it's crossing the 100-day moving average. Thereafter we observed that the prices corrected sharply and tested almost 89 level. After that the prices were trading again very range bound, and by the month of October again we saw that prices forming some positive pattern, as well as the moving average, 50-day moving average, giving a positive crossover from downside to 100-day moving average. Thereafter, after the crossover, we observed that the prices pick up their northbound journey. Relative Strength Index. RSI is one of the most popular and most widely used technical indicators of all. The RSI is an oscillator as it fluctuates in a fixed band between 0 and 100, with 50 being the central value. By default, most charting platforms use 14 periods to calculate the value of the RSI. Market can remain in overbought or oversold for extended periods of time. So this is the chart of USD dollar, and you can see that in the year 2020, the prices make a negative pattern, and also the RSI was trading too much in overbought region. So we saw a good correction in the prices. Again, in the month of May, prices form a negative pattern with RSI in the overbought region, which again lead to correction, and prices corrected till the level of 88. We saw a positive pattern over there, and RSI was too much into oversold region. So after that, we saw that prices started moving upwards. Similarly, in the month of May again, we saw that prices form positive pattern with RSI in the oversold region, and again the prices took upside journey. And recently, in the month of May, we saw a negative pattern with RSI trading in an overbought region, which led to a correction in the prices. Third is range trading strategy. In this strategy, the traders trade in a specific range of price. One needs to identify favorable price range for trading. The price levels are usually dependent on the demand and supply of the currency. Range trading in Forex market works best when market lacks direction and long-term trend is not clear. Steps to follow while doing range trading. First step, identify the range. The first important step is to identify the trading range. This can be located after a currency has recovered from a support area by 2-3 times. Besides this, the currency should have retraced from a resistance area by 2-3 times. So let's try to understand how to identify the trading range with the help of a support. So this is the chart of US dollar, and you can see that prior to year 2021, the prices have corrected sharply, and they took support near the level of 84. After that, they have rallied, and again in March they have corrected slightly, but however took first support at 84 levels. After taking support at 84 levels, it again rallied, and by the month of May to June, prices corrected. And again in the month of July, they took support at 84 level. So what we have observed that 2-3 times the prices have taken a good support at 84 levels. Secondly, after that the prices have rallied, and then again face slight correction in the month of August-September and took support at 91 level, and again the prices have rallied. So this is a clear example that if prices are taking multiple support more than 2-3 times, that can be a starting point or a buying level for your trade. So now let's understand how to identify the trend with the help of resistance. So you can see that prior to 2021, the US dollar was falling, and it took support almost near to 89 levels, and there it formed a positive pattern, and after that it started its upside journey. However, it faces resistance around 93 levels, and again it started its southbound journey. So multiple times we have observed that at around 93 levels, prices have taken a lot of resistance. So if you want to trade in this range, then one can actually go short around 93 levels, and then they can capture the downside trade. Step is set up the entry, which means buy at support and sell at resistance level. So this is a chart of US dollar. You can see how the prices have corrected and taken support at 89 level. So at this level you can go long. On the upside, the price is continuously taking resistance at around 93 level. So there you can create a short position. Third part is defining the stop loss. So with your range identified and your entry set up, you must not forget the final part of the range trading. Stop loss is always a crucial factor no matter how you choose to trade. but it carries much more importance when you choose to trade in a range. Placing a stop loss above a previous high when you are selling at the resistance zone of a range, and at the time of buying, placing the previous support low as a stop loss. So now let me tell you how to take a long position. So this is a chart of US dollar and Canadian dollar. On the chart you can see that how the prices have corrected from 1.28 levels till 1.22 levels. 1.22 level is a very strong support. Also we have seen that in the past also prices have bounced back from this particular level. Besides this, what is interesting to note is that it has formed a positive pattern. So with these two conditions, one can go long for the target of 1.24 and for the target of 1.26. Now comes the stop loss. So this red candle low will be the stop loss for this long trade. All the above mentioned strategies one can apply in cross currencies also. After understanding different type of trading strategies, the next most important aspect to take care of is how to manage the risk. Some of the points one should take care of while managing risk. First is appetite for risk. Second, position size. Third, stop losses. Fourth, leverage. Fifth, controlling your emotions. And sixth, span margin. To know more about price pattern, retracement and span margin, you can click on the below mentioned links. We hope this was useful and it helps you to understand the basic of the forex markets and different trading strategies one can use in forex markets. Thanks for watching. If you like our video, like, share and subscribe to our channel. Thank you.